The auto rally continues as companies cut prices to pass on GST rate cuts. The sector leads gains led by Bharat Forge, Tata Motors and M&M.
Metals are the top sectorial gainers. Brokerage firm Morgan Stanley turns constructive on the sector, upgrading JSW Steel, Tata Steel and SAIL. All sectorial stocks trade higher in trade.
Samvardhana Motherson sets a revenue target of $108 billion and an ROCE of 40% by FY30. The stock higher by 3.5%.
TBO Tech continues to surge following its acquisition of US-based travel advisor Classic Vacations. The stock is higher with a gain of around 7%.
Shares of Prime Focus locked in upper circuit for the second session after notable investors Ramesh Damani, Utpal Seth, Madhu Kela buy stake in the company in Friday's block trade.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and the markets are holding in the green. There are pockets of strength, the broader markets in the green as well. Mangalam, you have to say the bulls, they have started off the week on a positive note.
It started on the positive note. The way they end will be, the test of that, because over the last few trading sessions, every time the Nifty has gone to levels closer to 24,900, closer to 25,000, we've seen some supply come by. The question is whether that sustains or not, and whether there is that expected short covering that comes by or not. 93% of FI positions on the short side. But there are a lot of stocks which are moving around, irrespective of the consolidation that we're seeing in the market. And one of them is TBO Tech, which is in focus on account of the acquisition that it did. $125 million is what they paid for Classic Vacations. And those are the important points that we will discuss with the management as well. The growth and synergies coming in from Classic Vacations acquisition, the near-term outlook on travel industry, and more importantly, overall long-term revenue mix and take rates as well. Ankush Nijhawan, who's the co-founder and joint MD of TBO Tech, joins in. Along with him is Gaurav Bhatnagar, who's again a co-founder and joint MD at TBO Tech. Gaurav and Ankush, thank you so much for joining in. The street clearly likes this acquisition. Ever since you've made this acquisition, $125 million is what you've paid to scale up your revenue in the US, which accounted for just about 5% of your gross transaction value. Ankush, just a question to you with regards to the operational and revenue scale synergies that you would get from an acquisition like this. Immediately, yes, it adds about 30 to 40% to your revenue. Brokerages estimate a 4 to 5% EPS accretion over the next few years as well. But from your endpoint, where do you think you can scale TBO's organic revenues because of this acquisition? And where could the cost synergies come in? Have you put a number to that?
Good morning, Mangalam. Mangalam, this question I would request Gaurav to take, if that's okay.
Go ahead, Gaurav.
Yeah, hi, Mangalam. Thanks for having us over. So, Mangalam, we have to look at this acquisition from two perspectives. One is the US market entry. This is one market where we had been the slowest to enter, and we had made a couple of attempts in terms of different strategies for the market. So this acquisition makes a lot of sense because now it gives us significant scale in what is also the largest outbound travel market in the world. So as our business matures, we would expect the business to reflect the global mix of luxury travel demand. And from that perspective, we would expect US to be one of the largest or maybe the second largest market for us. So this gives us a significant scale. The second aspect to look at, and which I think helps the overall business for TBO beyond US as well, is the access to luxury travel supply. We shared this data in our analyst call as well last week, that the average ADR or the average daily rate at which Classic operates is nearly $1,000 per night compared to the $250 per night that TBO does right now. So we've started from what we call premium outbound travel, so which is more like 4-star deluxe, early 5-star. Classic, on the other hand, firmly operates in the luxury end of the spectrum. So we start getting access to that supply, and that supply is relevant not only for the US outbound market, it's relevant for luxury travel overall, right? So for example, Europe is a big destination for Classic right now, and Europe is also a large destination for TBO. So we expect that, yes, standalone accretion from what we get from this business is what it is, and I think the analysts have a view on it. But we have to look at it from a broader perspective, saying that if the company's thesis has been that luxury travel is the segment that will grow, and this is also the segment that is largely serviced by travel advisors, then it helps us entrench ourselves in that end of the spectrum as well.
All right. Hi, Ankush and Gaurav. Congratulations on making this acquisition. It seems to be strategically good And also, the street is optimistic because the kind of addition on the revenue as well as on the EBITDA front. So that's good. But a couple of questions out here. One is the acquired entity, the last 3 years there's been no growth. So do you see growth come back over there? If yes, where do you expect this business to scale from around $100 million? Point number one. Point number two, the margin gap is close to around 700 basis points. They are at 10%, you're doing close to around 17%. Will it be that, these margins of the acquired entity as well gradually moves up maybe to mid-teens in the next few years?
Yeah, no, fair questions, Nigel. Look, I think from a perspective of growth, two things to keep in mind over here. One, the US has seen a fair bit of turbulence last couple of years, right? Because of the geopolitical environment. So, for example, Mexico is a big destination for Classic, and outbound to Mexico has been, meaningfully hit from US overall. So, I think that is some macroeconomic headwind, which we expect to see a turnaround over the course of time. Second thing to keep in mind is that Classic was so far owned by not by a strategic owner, but by by kind of like a private equity / family office. So the priorities were very different, right? I think they still, in spite of a flattish top line, they did show bottom line growth. So the priorities were very different when you're owned by a private equity as when you're part of a strategic larger setup. So we definitely are banking on organic growth as well in the Classic business from the synergies we will derive. The way we'll also look at it is that how fast can the North America business or TBO as a whole, including Classic, can grow. And there we remain very optimistic. I think I'll not hazard to give any forward-looking numbers on this. We would definitely expect top-line growth to happen. On the bottom line, Nigel, I think we have to first understand how the Classic business is slightly different from the TBO business in terms of how revenue gets measured. So Classic works on what's a commissionable model. So you would see the take rates are very high, almost 23%. Now, half of that take rate is actually just a commission that goes back to the travel agents. So about GP, is hence 50% of the overall take rate. Even at that, GP is quite impressive at 11%, which is more than double of what TBO does organically. So I see that as a big positive. Now, as you know, these businesses demonstrate operating leverages. So our expectation is that as we enable the business a little bit, all top line growth should meaningfully go down to the bottom line, and hence we should expect EBITDA margins to improve. Very hard to say will the EBITDA margins converge at where the broader TBO margins are. But if I was to look at another metric of where is the EBITDA as a percentage of GTV, then this business is already accretive for us, right? They're nearly 2% plus on EBITDA as a percent of GTV, which is how many of the large mature OTAs, measure their financial outcomes. So from that perspective, this business is already accretive, and I think it'll grow from there.
All right, we take that point. But, from a improvement standpoint, if you could tell us, are you working with, say, 100, 200 basis points improvement? Yes, difficult to say whether they converge or not. But at least from what you can see right now, there should be at least 100, 200 basis points improvement?
Are you just, putting a little bit of words in my mouth there, Manglam? But look, I think...
No, we're asking for...
We're asking you out of curiosity, because the current difference is close to around 500 basis points. You're saying it will obviously not converge. So I'm saying, will you meet them halfway?
That may be one way to look at it. I think in the short run, and look, we have yet to own the business in the sense that it closes in the first week of October, right?
Yeah.
So for us to be able to create such a granular perspective on the business is a little bit hard. We have identified synergies. I would be surprised if we don't deliver at least a couple of percentage points in EBITDA improvement over the next 2 or 3 years.
Got that. A couple of percentage points improvement in EBITDA and meaningful improvement in growth as well. As the ownership has changed, focus will change as well. Ankush, we asked you a question. You directed it to Gaurav. Let's ask you a question again. If you could give us a growth breakdown for the ex-Classic Vacations current business for you. The first quarter obviously was impacted by disruptions. The second quarter, have those disruptions continued? What is the outlook on growth for this year, GTV, on both airlines as well as hotels?
So, Manglam, I think it was a very, very tough last quarter for the obvious reasons we all know. But I think Q2 is showing some promising traction, I think, and we are doing things which we're supposed to do. And yes, there's a lot of positivity in the market now. I think the Q1 is behind us. Plus, with the festive season, especially coming in India, with Diwali and the Dussehra breaks, we anticipate some good movement happening, and I think in terms of our forecast for growth, we are in line what we think we should be delivering, but as a company, Mangalam, we don't give any forwards, but what I can tell you is our focus remains, and hopefully we'll deliver what we have been talking to the market.
Okay, all right. I wanted to get your view on a direction for the profitability of the company, because one would say, it's more than a $2 billion market capitalization company and giving net profit of 220 crores in the last year.
Yeah.
But the street is optimistic about the prospects ahead. So I'm looking at a Jefferies note. They are talking about profitability move from an early 200 crores to close to around 380 crores in FY27. And post that, they're also talking about 500 crores of net profitability. Do you think that's the direction the company is headed? Because if you take that into the equation, then the company doesn't look too expensive. What's your take?
So I think the 380, is obviously was something which was, not before Classic's acquisition, right? So we are fairly confident, to move in that direction. And obviously, Jumbo Online, which was an acquisition, if you remember, Nigel, is now going to have a full year with us at TBO as well. And the 500, I think what Jefferies is obviously crores. What Jefferies is giving is keeping in mind our, full year of hopefully, delivering the Classic acquisition, as Gaurav mentioned in the beginning. So I think we are moving in the right direction. Plus, we believe that sometime next year our operating leverages will start playing up. Because there has been a lot of front loading in terms of building our distribution. Not just in India, overseas as well, very aggressively. So hopefully that will play up and give us some operating leverage. Which we've been talking about in somewhere in 2026.
And at what level will the hotels and airlines mix sustain?
I think it's a conscious effort, Mangalam, for us to build a hotel business, because that's where real profitability comes in. Nevertheless, our airline play in India is extremely important because one, it gives us a lot of meat in building our platform in India and cross-selling hotel business. Plus, I think the whole growth of aviation happening from India is something we cannot ignore. But yes, I would say at least 80-85% of business will be our hotels, which will obviously make our EBITDA and profitability much better, because that is the higher margin business for us across.
Take that point. Thank you so much for that. The street likes the acquisition. Over the last month or so, the stock has rallied about 22%. You believe that with all the front-loading investments that you've made, maybe going forward, things would improve for you in the company, and that's what the street is betting for as well. Take a short break, come back, and more on the markets and a lot of stock-specific action. Gaurav, Ankush, thank you for joining in.
Welcome back. Markets continue to hold in the green. The problem yet again is the Nifty bank. That's not coming to the party. That's still down only around 30 points or thereabouts, underperforming the Nifty. If that gets its act together, it's like the star batsman coming to the crease. Let's see whether or not that can happen. But let's get in Shivangi Sarda, who joins us on the show. Hi, Shivangi. Good morning. Good to see you in. Hope you're having a good start to the week. What's your view? Nifty is good for more? Or do you think we're going to be in this range? What would the fresh trade be?
Thank you for having me. So we've seen that the indices have witnessed kind of volatile cues from the last few sessions. And, even though there has been a comeback of the bulls, but then the sustaining at the higher levels has been quite questionable. Now we are, standing above the key support levels of 24,650 marks. But then again, we'll have to hold above 24,800, which also happens to be the 50 daily exponential moving average level for the next leg of rally to commence and, cross the psychological 25K barriers. So it needs to hold these levels again, for the fresh leg of rally to continue. But we are going for buy on decline stance, as we have been seeing that, higher bottom structure can be maintained from the last 6 trading sessions. So overall, markets are steadily moving forward, a bit of volatility, but again, we are heading northwards. So we are
all right, heading northwards, and buy on decline is something that you would prescribe to all your clients. Interestingly, not only is the Nifty bank underperforming, the Nifty IT index too has been buoyed down right now. And ever since the GST announcement that has come in, the GST cut announcement, the FMCG pack has been on a bit of an extended profit taking as well. So the FMCG index comes up for you currently at the lower end of today's trading range, just above the flat line for that index. What do you think would power this market ahead, Shivangi? Are there any individual stock sectors that you're betting on?
So stock-specific ideas on my radar has been first up from the auto space, which is in a lot of action. M&M has been catching attention. From the last 17 weeks, it had consolidated, and now it's coming out of the range with good volumes and price action seen here. So this one's on radar with good open interest addition as well. So recommending a buy here with a target of 38.50 and a stop of 35.80 levels. And the second pick on my radar is Paytm. Of course, new age digital companies are in focus, and this wallet has been respecting its 50 daily exponential moving averages from the month of April this year. So we've seen that good retracement level from any small declines and holding at the higher levels quite resiliently. So 1300 is what we're looking at for Paytm with a stop of 1225 levels.
Okay, all right. Thanks a lot for that, Shivangi. Well, I think time to slip, into a short break. Actually, before that, let's focus on our special segment where we get you a few ideas for profit from Money Control Pro. Bharat Jihani of moneycontrol.com joins us to talk about a stock that he's tracking closely. Bharat?
This ideas would be NCC Limited. The company posted weak Q1 results with revenues declining by 6% YY. Delayed project approvals and payments led to a weak Q1 results. Despite a weak Q1, the company has retained its growth guidance of 10% for the current fiscal. Improvement in the project payment cycle as well as approvals would lead to a strong performance from the current quarter. The company sees a good order prospect pipeline worth 2.5 lakh crore rupees in the current fiscal. The company has already backed projects worth 7,500 crore rupees in April to August period. Additionally, the company is L1 bidder in projects worth rupees 5,000 crore. The company has retained its order inflow guidance of 22 to 25,000 crore rupees for the current fiscal. Additionally, the company is sitting on a strong order book worth rupees 70,000 crore. This is about 3.2 times FY25 revenues and provides a strong growth visibility going ahead. The company has a strong balance sheet with debt to equity of 0.3 times. A stronger balance sheet will ensure smooth project execution. At the current market price, stock is trading at a PE of 12 times FY27 projections. Investors can add this topic. Thank you.
All right, Bharat, thanks a lot for that. With that, we'll take a short break and come back, get you more on the markets. A lot of stocks buzzing around. We have Eicher Motors, which has moved to the high point of trade as well. As we speak, the auto stocks obviously have been a buzz. Well, ever since the GST cuts were announced or expected, the fresh leg of rally has come by in the auto space, and that continues even post the announcement. So we were talking about Eicher Motors, M&M doing well. Look at something like a Bajaj Auto and Maruti as well. All of them moving higher and very close to their all-time highs. For Maruti, just within 1% away from its 52-week high as well. And we're seeing that support come by in a lot of these auto ancillary names too. Just keep an eye out on a couple of these new age companies. Delivery, as we move towards the festive season, new age logistics would be in focus because e-commerce typically sees a high delivery season during this time, and delivery obviously has a higher share in that part of logistics. So that stock doing fairly well in trade. But speaking about the GST itself and the impact that it could have on the government's economic roadmap, the fiscal deficit, etc., we had an exclusive conversation with the Finance Minister, Nirmala Sitharaman, who said that GST rationalization has been a key driver of consumption without compromising on fiscal discipline. She also urged industries to go ahead and pass on these tax benefits to consumers. We've seen auto companies go ahead and take those cuts. Sudhir Sithapati said the FMCG industry too is committed to passing on these cuts. The Finance Minister spoke with Network 18's Rahul Joshi.
You've put more money into the hands of the consumer. You brought down for the middle classes, the income tax cut, and now rationalization of GST. So will it now finally sort of move the needle on consumption?
100%. Because there's more money given already through the income tax cut.
Right.
The rates are coming down. So the citizen now has a choice to meet his aspirations and his expectations. He cannot say, look, I have the money because the income tax is reduced, but these items are beyond my affordability. Now everything has come down. Okay? I'll give you this number which is important. 99% of all the goods and services which are touched by GST are now either in 0 or in 5 or in 18.
That's right.
There's nothing beyond. So that 1% is what makes for the demerit goods, which popular parlance says sin goods.
Yeah.
So that is the extent to which we have cleansed the system of anomalies, doubts, duplications, and any interpretative issues.
So this will also lead to higher investments. It will fire up investments as well.
Obviously, with consumption going up, there's a potential for capacities to grow, investments to grow.
Now the combined tax revenue impact of this, earlier your income tax cuts, and this is about 1.2 lakh crore. Do you think that there will be a certain revenue buoyancy as well in the coming years to make up for this? And
every economic theory that one studies says that.
Yeah, have you seen that in the past?
Well, at least the moment the income tax reduction happened, you heard people very clearly coming out and says, I've met up with a lot of individuals coming from different strata of the society saying, I'll have more money to send my son to this particular college. My daughter is already doing engineering. I'll be able to fund her for her higher studies and things like that. And from ordinary citizens who are leading their lives either working in a small store or driving a car, taxi, and so on. So it has an immediate psychological effect that I can do this, which was beyond my affordability. And therefore, I think there will be a buoyancy in terms of revenue.
Any impact on capital spending or fiscal deficit?
I wouldn't think. At this moment, I can say with confidence, capital expenditure of the government will not come down. It will be completed as is stated in the budgetary planning time, the budget estimate time, and so with the fiscal deficit. And this is the last point of my gliding path.
Right.
I will adhere to it.
Will petroleum products and alcohol continue to be outside the ambit of GST?
Yes, the current proposal doesn't include it.
Right.
The states will have
and
to.
You don't see that happening in the near future?
Not in the immediate future.
Well, as we move towards the end of Chartbusters, just keep an eye out on TBO Tech. That stock has moved to the high point of trade, up 9%. It was already buzzing. We had a word with the management. They do believe that US revenues are likely to grow. Thereafter, there would be margin improvement in the acquisition that they've made as well. And overall business in India would, while come from airlines, they are focusing on hotels because that is where they make higher money. That's where the higher take rates are. So Street likes all of that. The stock up nearly 9%, over and above what it was before the management joined us as well. Meanwhile, we're also seeing some traction in Parag Milk. Remember, dairy stocks have it better because of the GST rate rationalization that has come in. Nearly all of the portfolio is at either 5% or 0%. So that stock up nearly 6%. What we'll do is take your leave on this edition of Chartbusters with the news that the Nifty Bank has slipped marginally into the red, taking the Nifty lower by about a few points as well. The Nifty is just up by about 50 points, so we'll watch out for that. From Nigel, me, the entire team, thank you for watching.